Hey, Ian.
Hey, Jordy, how are you?
Good. You've had a busy day.
As of you, fresh off your presentation.
And those who didn't see, Ian was chairing the 6 Minute Lawyer at the Law Society today all morning. A bunch of great presentations, and some of which tie into what we're going to talk about today, which is our second part of multiple will planning, and some, especially on the decision making when we're recommending it, and when and some drafting suggestions, as well as answering some questions. So we have a pretty packed presentation today. So maybe we talked about last week sort of how in theory multiple wills work, and why they work, and why you need them, and how to determine what assets go in what will, and things like that. And now I'd like to sort of turn into maybe your first point about frequency of using multiple wills, and what assets generally you use them for.
Sure, and that's an expanded frequency in my view, as we get more and more comfortable with using this tool. There are situations where we would not normally think of using the multiple will situation, and of course the classic was when it first came out. It came out for the purposes of sheltering or avoiding the probate tax for corporations, closely held corporations, and that is a very narrow view of how to use them. So your first slide gets us jumping into the broader perspective.
Right. So these are a few of the classic assets that you can use multiple wills to avoid probate on. So personal effects, again, thinking about the test, which is, are we going to need some sort of government approval to transfer assets? Are we going to need some third-party approval to transfer assets? Personal effects, nobody's going to need authority to transfer your furniture and photographs and things like that. So that those can pass outside the will, the probated will, and therefore it can be dealt with in the secondary will. Number two is one we've spoken on many, many times, and sort of fundamental concept here is that, even though you can avoid probate on certain assets that are held on a resulting trust for the estate, you need to deal with them in a will that you're not submitting for probate in order to avoid the probate tax on them. So if you're doing any kind of resulting trust planning, either having a kid on title to a property, but as a bearer trustee, or a corporation as a nominee trust owner and bearer trustee, you need to use a secondary will to avoid the probate tax on those assets.
Yeah, so 2 points. One, on the personal effects, of course, really good idea to very carefully consider using a secondary will for that. It's not top of mind often, but it avoids your EIR issues. It's very difficult to often sort of properly value personal effects. And of course, we can pull the government out of that audit if we put it in the secondary wills. And then the idea of the resulting trust scenarios, of course, mindful of the fact that in a bear trust situation, we have obligations to CRA to be careful with in terms of our obligation to report ownership and so forth with trusts generally, and of course with bear trusts. So be careful about the pre-planning and the impact of it, and then the post-planning. How does it fit in? But it's certainly a logical tool in the secondary will.
Right. So if your client comes to you and says, "Oh, my financial advisor told me to make everything joint with one kid, and I need a new will," that's when you're going through your checklist and you see there are assets being held on a resulting trust, that's going to prompt you to think about multiple wills there. We've talked before about registry system real estate and first dealings where there's been a conversion from registry to land titles. That's another example of when you need to consider a secondary will to deal with that asset. And we have a presentation on that and how you determine whether an asset is available to the first dealings exemption. And so that's another one on your list. And four is debts that are owing to the deceased, even if they're going to be forgiven, are assets that typically don't require probate. If you're going to forgive them, they're not to a third party, so no third party is going to be involved, and those probate tax would normally be payable on that if you only had one will.
Yeah, and the registry and the land LTQ real estate issue has eliminated the awkward planning we used to see sometimes where people were putting principal residences into trusts and so on. This is such a, if it can work and it's LTQ qualified, it's such a good tool to just put it into your secondary will and avoid that headache.
And just to clarify, I mean, the idea of being held on a resulting trust, that means it belongs to the deceased and it belongs to the deceased estate. And it's usually the trustee of that is a bare trustee. That is that the legal owner has no rights to that property. And so that really is a bare trustee. LTQ is land titles qualified real estate. And I recommend that you see one of our previous videos on registry system and land titles qualified dealings with properties to avoid probate. Then we've got, this is, Ian, you raised this is the corporate assets, right? The shares of a private corporation, shareholder loans are the two classic reasons why we're going to do multiple wills. Assuming the other four of the first ones don't exist or the client isn't concerned about them, and we'll talk about when they should be and when they shouldn't. Shares in a private company are the number one sort of reason why we do multiple wills, I would say. And the whole point here is because under the Business Corporations Act, probate is not required to transfer private company shares. All that's required is the board and the approval of the board of directors. Clearly, if the deceased was the sole director or one of the controlling members, they can vote those shares. The deceased's estate can vote those shares after death to elect a board that will authorize the transfer of those shares. And that's why you can use a secondary will to deal with corporate assets, because where there's control of the board, basically nobody's going to need approval or probate of the will. Ian?
Yeah, and this planning scenario comes out of a lot of estate freezes, obviously, where the head of the families, heads of the families get a freeze value, but they maintain control of the company. And so those preference shares pass on death and the executors have control. So control is typically there in the estate side. It's atypical to see it otherwise. And that's why, again, comes back to this, remind ourselves, why wouldn't we do this? Why would we not do this in a situation? Is there a really good reason not to do it, as opposed to should we do it? Because the planning is almost always going to fall in your lap with the control piece. So there is really no excuse to avoid it.
And if you only own a small percentage in a private company, you don't likely control the board, and therefore you're at the whim of the board as to whether they're going to require probate or not to deal with it. And that's why typically you see when we talk about private company shares, we're talking about shares that you have a controlling interest in, or your spouse has a controlling interest in, et cetera. So that's what that's, I think, important. Although sometimes people put even minority interests in a secondary will, but there is that risk that the board won't authorize the transfer. So those are your classic ones, but I wanted to run through some other ones, and there are many, many other ones. But think about any asset that you can transfer without probate, and those could conceivably be in the secondary will. So life insurance that you own, that the deceased owns on other people's lives, can typically be transferred. Partnership interests, loans that are owing from a trust to the deceased. I mean, think about that for a second. You control the trust. The trustees control the trust, who are friendly. They owe money to the deceased, the estate. They're not going to need probate, and so that's another asset that you could typically, if you're going to do multiple wills, typically include in the secondary will. Ian, anything in those first three?
No, I mean, this slide sort of speaks for itself. But many of these clauses should actually be provided for in both wills, but absolutely.
Yeah. And so, and again, thinking about other assets that don't need, land leases. There are all kinds of assets that you can do an analysis on, and sort of figure out whether they need probate or not. So I want to turn to the considerations, and in your theme is we should err probably more often on doing multiple wills. But here are some touchstones that may make multiple wills more necessary or less necessary, or better fit the situation. The client's age and health. We're talking about, saving probate tax, so not income tax, probate tax when the person dies. Now, if they're going to spend a lot of money now or more money now to potentially save money in the future in 30, 40, 50, 60 years, might make less sense. So the client's age and health. On the other hand, you have an elderly client, life expectancy or diminished life expectancy, the likelihood of getting the tax benefit of the probate tax savings is in the near future is much higher. And so that's again, the cost benefit analysis. The current asset value. Again, you're saving probate tax by doing a secondary will as at 1.5% of the value of that asset. If that asset is worth $1,000, you're not going to run out and try to save, $150 or $15, sorry, on that. If it's worth 100 million, you are, obviously. Okay.
Just on that point, value is, I always look at the benchmark. Remember, 17,500 is your law pro claim, and from that standpoint, I always remind myself that you can get to that number pretty quick with a probate slip up. But what's not on your list, and one of my foundational considerations too, is that by putting it into a secondary will, you leave open the possibility for dependent relief claims. And so there's the dynamic within the family is very important to consider. And sometimes it's a situation where we'll actually probate a secondary will, notwithstanding all of our efforts, just to close off the limitation period for dependent relief claims. But I'll let you continue on with your list.
But while you're on that point, that possibility of probating the secondary will, I mean, there's nothing stopping you from probating the primary will and the secondary will. And so, even in a situation where you have a potential dependent support claim, I mean, I'd still do multiple wills because I'm in no worse position if I have to probate both wills than if I did one will. And if there isn't a dependent support, if the dependent dies or doesn't make a claim or anything, I'm still protected. So that's my theory on that kind of issue. I might, down the road, they may make an evaluation at that time to pay probate tax and probate that secondary will. But from a planning point of view, I think I would still draft those multiple wills.
Oh no, I agree. Listen, I'm still my general theme is why not why. And I just say that to identify that it's worth talking to the client, saying, look, we're going to do all of this planning for all of these cool reasons,
right.
But it may backstop. It may not work at the back end, not just from a government changing the rules, but just from a protection standpoint.
Right. The future growth probability is also important. If they say, yes, I just incorporated a company, it's only got 50 grand in it, and they say, but I'm expecting that to grow, that's obviously, it's a date of death savings evaluation. And so if it's going to grow between now and death, likely, well, that's another reason to do it. Whenever you see resulting trust planning, take an elderly client who is widowed, for example, and they have relatively significant assets. They own a home and they have some investments portfolio. Well, maybe right now they haven't done any resulting trust planning, like adding a kid as a joint owner or a bear trustee corporation on title. But there's a possibility, and it's not an unlikely possibility, that down the road they will do that kind of planning when the time comes. And so, that's a reason why you might want to recommend, let's do the multiple will planning now to cover that down the road if you ever decide to do it. And then you don't have to change your will at the same time as you're doing that. Ian, your thoughts on that?
Well, I echo it, and I think it's absolutely right.
Yeah. So, those situations, widow, children, that kind of stuff, might be a good idea, because they might down the road do some resulting trust planning. On the other side, some clients say, look, I don't want all this. I just want a very simple, as many clients do, I don't want complexity, because multiple wills adds complexity. So, that might be a reason why you don't. But the benefit of future flexibility, taking account of future events like bare trust and resulting trust planning, I'm using that term kind of synonymously, there's a good reason to do that. And we'll talk maybe briefly about, what the cost might be. I'll just throw my 2 cents, just it doesn't mean much, but for example, if I'm doing a single will versus I'm doing multiple wills for a couple, I'm going to charge $1,000 more to do multiple wills. Now, it takes me precisely 0 seconds longer to draft them because I use software, but whatever you're going to do, there's a value there. And it's not just about time. There's a value there. You have to go through it. You've got to, all of those things. So there is definitely additional time spent, maybe not on the drafting, but on the explanation, on the execution, on the, liability, et cetera. So, you should, in my view, you should charge more money for doing multiple wills. Because
I just underscore the liability piece. So I agree with you. You have to build in pricing for it.
Yep. So let's just talk about some liability issues, Ian, as you defend these claims. One of the claims, of course, is where you choose not, for whatever reason, they don't do multiple wills. And the kids, of course, come back because they're the ones who ultimately the tax is coming out of their pockets as the beneficiaries. And they're like, oh, why didn't you do multiple wills for mom and dad, or mom, right? So, some sort of waiver of that is really important, I think, right, Ian?
Yeah, and I think, because I know you do and I do too, we video our intake meetings. At the meeting, I'll make it expressly clear that not only are you waiving it, but what's the consequence of waiving it. Because I find 99.9% of my clients, when they hear you're going to save tax, their ears perk up. And typically, if I can demonstrate that the tax you're saving just on doing the multiple wills is going to way exceed the additional cost of doing the wills today, they jump on board.
Yeah, for sure. And again, if you use software, it will report that out on that basis. And so the other thing that you can have liability issues is, where there's non-matching executors or beneficiaries, right? And then anytime there's a difference between the two wills, it's really important what assets fall into what will. And I'm going to just demonstrate some of that and some preferred suggestions, or my suggestions, and I don't know if they're preferred, but my suggestions on that kind of stuff. So maybe we'll turn to some of the drafting issues, and I'm just going to actually open up eState for a second, because I want to demonstrate the wording that we would sort of suggest. So any of our users know about our live viewer now. And so we're doing a will for Homer, multiple wills for Homer and Marge Simpson. The first important part of multiple wills that we'll talk about are just the definitions. And the reason the definitions are important is they set out what assets are governed by which will. And that's really important. So look at paragraphs GG, for example. That sets out, okay, my secondary will is going to govern my secondary estate. And those are my personal effects, my digital assets, my corporate assets, my trust assets, my registry system real estate, my trust loans. So a bunch of assets that we've talked about. And then my primary will is everything else, okay? So for example, registry system real estate, and there's different ways to draft it, means sort of that first dealing exemption property. Corporate assets means shares in these particular corporations, and often there's a sort of a general basket clause of any other private corporation that I control, or you can choose to, include my spouse controls it or my family controls it or whatever. So definitions of specific assets, and they have to match. So one of the things, Ian, I'm sure you've seen this in the liability side, is where the two definitions don't match in the two wills. And you have overlapping situations, assets that could fall into the primary will or are covered by both wills, which is what you don't want. You want to make sure that an asset is only covered by one will. And so that's one of the techniques, is to make sure that you define those assets specifically. There's also the issue of, assets that we think we might be able to avoid probate tax. And I'll give you an example. A private corporation, okay? You give your shares in a private corporation, but it turns out that by the time you die, you only have a minority interest, and the board is now requiring probate. Well, if you only had it in the secondary will, you'd need to probate that secondary will to access those assets. So one of the ways that we do it is we have the ability to disclaim assets. So if they would normally fall in the secondary estate, but for whatever reason we need probate on them, we can push them up to the primary will. And that's our technique for avoiding those assets that maybe down the road we've predicted improperly as falling into the secondary will and not needing probate, when in fact at the time of death they do. Ian, any thoughts on that?
No, this is gold. I'll let you keep going.
Okay. So the next thing that we're doing, and I'll just do kind of a live thing here. So I'm just gonna make this 15,000. So two things I want to talk about is a legacy amount, a cash gift, and then the other one is an asset gift. And the asset gifts we'll talk about first. So I'm just going to demonstrate. So what you just saw, by the way, is our live viewer. So you can make changes in eState and then instantly see them on the viewer. But you'll see whenever you make a gift of a specific asset, think about whether that asset, you are 100% sure that it will be in one particular will or the other, or else you better put it in both. And our general rule is whenever we draft a specific asset gift, even a home, okay, that we will put it in both wills, and we'll say that if it forms part of my primary will, deal with it there. And then in the secondary will, we'll say to the extent it forms part of my secondary estate, deal with it there. Why? And this, I know we've had a law pro claim on this very issue, is if there's a disconnect between where the asset falls, it falls, for whatever reason, it falls in the secondary will, and the gift of that asset is only in the primary will, we've got a major problem. And you might say, oh, it's a condo. It's a condo. We're going to need probate 100% for a condo. I'll just put it in the primary will. Yes. And then after they see you, they put the kid on as a joint owner using resulting trust planning. All of a sudden, it's part of the secondary will, and that gift lapses. So really important, if you're going to decide to only make a specific gift in one will and not in both, consider it very carefully if there's a potential for it being in the other will at the time of death. Ian, do you want to just jump in on that?
Well, I think you've said it, you nailed it, and so crucial that, as you say, I've already litigated this point, and it's not pretty.
Yeah. The other thing that we wanted to talk about was cash gifts, and cash gifts, right? Our typical planning is that we put it in the primary will, but in the secondary will, I'm just going to show you where it is in the secondary will. That it's not going to repeat the same gift twice. It's going to only reference the gift in the primary will. It won't repeat it. And so what we typically say is that if it's not satisfied under my primary will because of abatement, that is, there's not enough money in the primary will, then satisfy it out of the secondary will. and it's your intention to only be paid once, right? Because again, if you put that in both wills, it's a cash gift. We don't have to worry about it not being in one will or the other. What we do have to worry about is that there's not enough money in the primary will to satisfy it, and that would be abatement, and therefore we have it paid under the secondary will. So those are two specific issues with gifting that you have to concern yourself with in multiple wills.
Yeah, it's such an important point. Like this pour over between the two, of course, it's probably worthy of its own half-hour discussion, but that's a mini pour over clause that you are allowing, in a sense, pouring it between the two estates. And I've had the privilege of litigating Captain Estate, which is a reported decision that really hashed out the difficulty when this language is not included, and the impact of it. Where does it fall in which estate? No, sorry, in which will? Never two estates, always one estate.
Right on. And the other thing is that there are certain situations where typically the provisions of both wills are similar or identical. You get into problems again when they're not, and that's what I would be concerned about. We've got, for example, we've talked about bequests, devises, legacies. If you're using, for example, I'm going to give you an example here of you're making cash, mandatory cash payments. Okay. So you say, listen, I want my son or my spouse to get X dollars every year. Okay. So those kinds of mandatory payments, they're going to appear in both wills. So I'll just show you what I'm talking about. If we say, listen, they're going to get $100,000 every year as a minimum payment from this trust. Important that we don't pay that $100,000 from the primary will and the secondary will. And so a definition in your will, and I'll just show you what eState does, will clarify that. And so, for example, here is a situation where we don't want that $100,000 paid twice. So eState's gonna, or your drafting should always talk about, okay, when I talk about that amount, it's an aggregate amount, regardless of where it's getting paid from, whether it's the primary will or the secondary will. Those are issues. Hodgepodge, if you do a hodgepodge clause, for example, if I make a condition for a hodgepodge clause, then what's going to happen is it's going to say, to the extent that it wasn't counted against the share in my primary will, I want to count it against my share in the secondary will. And so that's what we have. Those are all little things that you can easily make mistakes on if you, for example, this is if, but only to the extent that the adjustment has not been fully made under my secondary will. Those are the situations where you can really get into trouble and that are special to multiple will drafting. In anything, we're just running out of time here, or at least running to the end of it.
If you got some questions you may want to just address quickly, I won't jump in. Sure.
So I've highlighted these provisions, by the way, in our slides, so you don't have to worry about following it on eState. So the compensation, typically you could do it if it's a fixed amount, you would do the same thing, right? You don't want it fixed under both wills of $100,000. But so that's certainly something you want to, anytime you've got a fixed amount, that's where you've got to deal with. We talked about briefly the hodgepodge clause being included in both wills. Yes, if there's nothing in the primary will and it's only in the hodgepodge is only in the primary will, we're going to have a problem. And so, again, if you use eState, it knows that and it's going to put it in both and talk about put in the right wording and things like that. I mean, multiple wills can really be a minefield if you're doing it manually, because there's so many things that you got to remember. And so, that's why we charge more. Especially if you're doing manual drafting, you should definitely charge more. In situations where assets are straddling both wills due to an error, which will governs, well, that's a problem. I mean, again, if you're probating the primary will and an asset is governed by the primary will, whether it's governed by another will or not, you got to pay probate tax on that. So that's where you don't want to make, again, the drafting should avoid most errors. There's no guarantee, obviously. So, but keep in mind those key elements of that we highlight in our slides about, real red flag areas, danger zones for multiple will drafting. So thanks very much, Ian. Thank you all for being here. This is a complicated topic, but one that we really need to know our stuff on, because it's, as you say, Ian, much more common than becoming more and more common all the time. And we'll see lots of it, I'm sure. Thanks, everybody.
Thanks, Jordy.
Yeah, and hope to see everyone on Tuesday for eState users for our user webinar. Tuesdays at 12:30, and then we're back here next week, 12:30 again. Thanks, everybody. Take good care.